Welcome to today's video. First, we will frame the question: is your low mortgage rate actually costing you tens of thousands each year through lost time and commute costs? Then, we will explore how the commute tax can outweigh higher mortgage rates. And finally, we will present strategies to move smartly, even in a higher rate environment. Let's begin. Next, let's set the stage. Many homeowners are emotionally attached to historically low interest rates, the so-called golden handcuffs. However, this attachment can hide large, ongoing costs in the form of long commutes and lost time. In this video, we'll challenge that bias with data and a decision framework. Before we dive in, here's our roadmap. We'll start by explaining how low rates can create a psychological trap. Then, we'll quantify the commute tax and time value of money. After that, we will compare scenarios with sample numbers and share practical strategies to move intelligently. Finally, we'll offer a decision framework, a long-term view, and a couple of quick quizzes. Before proceeding, a quick disclaimer. This content is for educational purposes only and does not constitute financial, tax, or real estate advice. Your numbers may differ significantly. Please consult qualified professionals to evaluate your specific circumstances. Now, let's quantify the commute tax. Now let's examine the commute tax. Two people driving a combined 100 miles per day and losing 2 hours each results in a total of 4 hours lost per day. Over a standard work year, that is approximately 1,040 hours of lost time. Conservatively, when you combine fuel, maintenance, depreciation, and a modest value of your time, this easily exceeds $52,000 per year. Note that this does not include the intangible costs of stress, fatigue, and reduced quality of life. As you will see, these commute-related costs can outstrip the monthly savings of a lower mortgage rate. Moving forward, let's translate time into money. With a $200,000 household income, a simple estimate divides by 2,080 working hours to yield roughly $96 per hour. Losing about 1,040 hours per year could imply an aggressive time cost near $100,000 per year. To remain conservative and aligned with the scenario, assume a combined cost over $52,000 per year, including vehicle expenses. The key insight is that even conservative assumptions strongly favor reducing commute time. Next, let's compare the trade-offs directly. Staying with a very low rate provides a lower mortgage payment today, but costs you significant commute time, stress, and long-term health risks. Meanwhile, moving at a higher rate likely increases mortgage payment, but it buys back time, reduces vehicle expenses, and improves quality of life. The result is often a net financial and personal win, particularly when the commute tax surpasses the payment difference. Let's put numbers side by side with a simplified example. If you stay with a roughly $400,000 loan at 3.25%, principal and interest are around $1,740. Adding approximately $800 for taxes and insurance, and about $4,333 in monthly commute costs, yields nearly $6,873 per month in total burn. If you move and buy at $550,000 with 10% down at 6.5%, principal and interest land around $3,126, with about $900 for taxes and insurance, and roughly $300 for a short commute, totaling roughly $4,326 per month. With 30% down, the total monthly burn can fall to approximately $3,633. These are illustrative only, but they show how commute costs can dwarf rate differences. Now, let's talk tactics for making a smart move. Now here's the playbook. First, eliminate high-interest consumer debt to improve cash flow and approval strength. Second, use home equity to increase your down payment, reducing the loan amount and impact of a higher rate. Third, search for assumable mortgages in your target neighborhoods to potentially inherit a lower rate. Fourth, consider temporary buydowns, such as 2-1 or 3-2-1 structures, to ease the transition. Fifth, be strategic with your rate lock and use float-down options if offered. Sixth, choose a location that minimizes commute time rather than maximizing square footage. Seventh, run simulations that compare total monthly burn, including commute, not just principal and interest. Finally, negotiate everything possible: seller credits, repairs, closing costs, and timing. Let's visualize a decision framework. The first question is whether you are losing 2 or more hours per day commuting. If yes, evaluate job stability over at least the next 5 years. With strong stability, check if you can fund a down payment of 20% or greater using equity. If so, moving closer and exploring assumable mortgages and buy-down options is recommended. If the down payment is smaller, moving can still be net positive if the commute tax exceeds the payment increase, especially when negotiating credits. If job stability is uncertain, consider renting closer to work or negotiating hybrid arrangements. If you are not losing significant commute time, the low rate likely remains beneficial. Throughout, eliminate consumer debt first and always compare total monthly burn, including commute costs. Zooming out over 15 years, we compare two paths. Staying at 3.25% accumulates a commute tax of roughly $52,000 per year, compounding to hundreds of thousands over time. Moving at 6.5% introduces extra mortgage cost, approximated here at about $9,500 per year over the first 15 years, though this will vary. The timeline shows an early crossover, typically between 2 and 4 years, where the commute savings outweigh the extra interest. Additionally, benefits to health, relationships, and career are not fully captured by the financial model. Before we quiz you, here is a quick recap. Time is the most valuable asset. Always compare total monthly burn, including taxes, insurance, and commute. Use your home equity and pay off consumer debt to soften the shift to a higher rate. Search for assumable mortgages and consider buy-downs. Above all, prioritize mental health and relationships. Quiz time. Which metric best captures the true cost difference between staying and moving? Option A, monthly principal and interest only. Option B, mortgage rate alone. Option C, total monthly burn, including mortgage, taxes, and insurance, or HOA. And commute. Option D, square footage per dollar. You may pause the video now to think about the answer. We will discuss the answer in the next section. The correct answer is C. Total monthly burn gives you the full picture by including mortgage, taxes, and insurance, or HOA, and the commute cost. This metric captures the hidden commute tax that can overwhelm the benefit of a lower rate. Next quiz. Which strategy can reduce rate shock when moving closer to work? Option A, ignoring consumer debt. Option B, using a smaller down payment and accepting higher PMI without negotiation. Option C, searching for assumable mortgages and using buy-downs. Option D, focusing only on interest rate headlines. You may pause the video now to think about the answer. We will discuss the answer in the next section. The correct answer is C. Assumable mortgages may allow you to inherit a lower interest rate, and temporary buy-downs can reduce payments in the initial years, easing the transition. Here are the key takeaways. First, the commute tax is real and often greater than any savings from a low mortgage rate. Second, reclaiming time enhances health, relationships, and career longevity. Third, always compare total monthly burn. Fourth, leverage equity, debt payoff, assumable loans, and buy-downs to reduce the impact of higher rates. Finally, remember that this decision is fundamentally an investment in time. To wrap up, low mortgage rates can become golden handcuffs if they trap you in a punishing commute. A conservative commute tax exceeding $52,000 per year can justify moving even at higher interest rates. Smart financing and negotiation can blunt the impact of rate increases. Over the long term, time almost always beats the rate. Invest in your life and well-being first. Finally, thank you for watching. If this helped you rethink the real cost of your commute, please like, share, and subscribe. Tell us your situation in the comments and estimate your commute tax. We look forward to hearing your stories and questions.